The recent flow in the average 30-year mortgage rate in the United States, surpassing 7.6%, has lightened up widespread concern. This projection, reaching its highest level since December 1, 2000, has pushed the housing market into the spotlight, raising questions about its stability amidst rising economic pressures. The rapid increase of mortgage rates has expanded existing anxieties, painting a grim picture of an overheated housing market on the extremity of instability. How did we reach this point? Understanding the underlying factors driving this unsettling trend is crucial for going through the uncertain economic landscape ahead. In this video, we will go through the complexity of the current housing market crisis, shedding light on the delicate situation and its implications for the future. Stay tuned as we reveal the difficulties and explore potential outcomes in the face of this looming crisis. The impending housing crash is anticipated to be unprecedented in severity. By going deep into the historical data, we uncover compelling evidence indicating that the current situation is far from typical. Many analyses of housing prices fail to address a critical factor, which is inflation. Over extended periods, the impact of inflation is often underestimated. For instance, a house purchased for $200,000 in 2000 would equate to approximately $356,000 in today's dollars. Thus, while it may appear as a gain on paper, in real terms, the increase is negligible. To accurately gauge a housing bubble, we must adjust for inflation to assess how much home prices have truly increased. The inflation-adjusted Case-Shiller Index provides a comprehensive view of real home prices, devoid of the distortion caused by the depreciating dollar. By comparing historical data, particularly the huge 2008 bubble, with current trends, we observe a concerning pattern. Despite the historical trend of rising real prices over the past century, today's housing bubble appears to surpass even the unprecedented levels witnessed in 2008, as evidenced by the pioneering research of Robert J. Shiller and Carly Case. The departure from historical norms since around 2012 indicates a concerning deviation from what was once considered normal. This departure prompts consideration of the factors that may lead us back to a more stable state. One pivotal aspect of this argument lies in historical interest rates. Historically, interest rates were significantly higher, but over the past 3 decades, we've witnessed a steady decline in rates. This decline set the stage for the development and eventual collapse of the 2008 housing bubble. Following the 2008 bubble, the Federal Reserve persisted in suppressing rates to new lows, reaching a nadir of 2.6% at one point. This accommodative monetary policy initiated another upward direction in housing prices, rising by 66% in real terms since late 2011. Such uncommon acceleration has no historical example, which is always leading to subsequent crashes in an effort to realign this phenomenon with historical averages. If you find yourself thinking that the chart isn't convincing enough, there's additional evidence that I believe is crucial. It demonstrates that there's significant pressure building within the market, suggesting an imminent shift. But before we get into this evidence, I would like to ask for your support in boosting our channel. Please consider taking a moment to show your support by liking this video and subscribing to our channel. Your engagement is greatly valued and greatly appreciated. Thank you for being a part of our community. Returning to our discussion, it's crucial to understand the significant impact interest rates have on the housing market. Most buyers and investors rely on loans, often the 30-year fixed mortgage. Without delving too deeply into the technicalities, it's important to note that the 30-year fixed-rate mortgage is closely tied to the 10-year Treasury. Essentially, fluctuations in this financial instrument determine mortgage rates. So, how does all of this relate to the value of your home? To answer this question definitively, we need to grasp some context. Think of a 10-year Treasury note as a unique type of paper that the government utilizes to borrow money. The process is straightforward. Individuals provide cash with the assurance that the government will return it with a bit of interest after 10 years. Presently, the interest rate they're offering is 4.5%. Now, let's get into something interesting. There's another Treasury note, the 2-year one. And guess what? Its interest rate is 5.02%. That means the government is offering a higher interest rate to borrow your money for 2 years compared to 10 years. Typically, it should be the opposite, where longer-term borrowing attracts higher rates. When this happens, it's called an inverted yield curve. In simpler terms, inverted yield curves are a clear sign of an upcoming recession. Whenever this happens, there's almost a guarantee of a recession occurring. Looking back at the chart since the late 70s, every time the line dipped below zero, indicating an inversion, a recession followed. This pattern held true in the early 80s, early 90s, early 2000s, 2008, 2020, and now. Although the chart is from 2022 and doesn't reflect recent developments, it's evident that the inversion has deepened and is now beginning to recover. You might be tempted to think that the situation is improving since the line is starting to move back up, but that's not the case. The reality is quite the opposite. Historically, the worst part, and when the recession usually hits, is after the inversion is over and the line crosses past zero into positive territory. Take 2008 for example. The real economic downturn began years after the inversion occurred. Currently, we're facing a deeply concerning situation. Despite the FED's efforts to push rates to their limits, the bond market is indicating skepticism. Take, for instance, the similarity between the 30-year yield and the 10-year yield. This suggests that investors are anticipating significant inflation down the road. Typically, investors would opt for a 30-year treasury if its rate was appealing. However, due to the uncertainty surrounding the upcoming years, the rates are not as attractive as expected. Investors are willing to buy the 10-year treasury at the same yield as the 30-year because they require an incentive for the 10-year to sell. This incentive comes in the form of a rate that seems excessive when compared to the 30-year. Essentially, these treasury curves indicate that investors anticipate ongoing high inflation. If this holds true, one must consider whether the FED will increase rates to combat inflation, only for inflation to surge again. Eventually, for inflation to resurge, the FED must capitulate. And for that to occur, a crisis is necessary. The looming crisis is evident in the imminent collapse of the housing market facilitated by the current situation. Interest rate functions akin to gravity, and presently, we are navigating uncharted waters. Once a fracture occurs, it will precipitate the downfall of this colossal structure constructed since 2012. The bubble previously deemed substantial will pale in comparison to the impending catastrophe. Before concluding, let's explore the implications of this housing market crash on homeowners and investors. Beyond the rise in interest rates and potential economic downturns, it poses significant challenges for both ordinary homeowners and savvy real estate investors. Homeowners with adjustable rate mortgages or those considering refinancing may face difficulties coping with increased monthly mortgage payments. This could result in a rise of foreclosures and a surplus of homes flooding the market at drastically reduced prices. For investors, particularly those banking on continuous property value appreciation, the declining prices will present fresh hurdles. They could find themselves owning properties with a market value lower than their debt and experiencing reduced rental income. Thanks for tuning in. Don't forget to show your support by liking and subscribing if you found this content valuable.